Ron, welcome. So $185 price target, that's about the highs of the stock in 2021. So what are you factoring in macro-wise and logistics-wise with the adjustments they've had to make in order to get you to that price target?
Hey, John. So good to have, thanks for having me. Good to be here with you. A few things going on Amazon. I think the first thing we have to remember, at least think about, is we hear negative headlines pretty much every single day around the consumer, around macro, interest rates, et cetera. But yet we also heard back to school was better. We heard management come out, granted, a few months ago saying Prime member engagement is up. And now we're seeing just Prime Video becoming, in our view, more of an acquisition target for new Prime members versus just retention. And so we put all that together. We think about where Amazon is on a demand perspective from a user, from what users are using it more and more. We think greater wallet share. So that's on the retail side. You then go to the AWS side, and our view is that AWS continues to hold up extremely well, and we should see continued 30% growth rates. And frankly, our overall price target is based on around 20 times EBITDA, which doesn't seem as much of a stretch on 23 numbers, and we think the business is becoming more efficient. So that's more specific on just valuation, but the trends underlying the business seem to be in pretty good shape from our perspective.
I wonder how you factor in things like logistics costs, which Amazon often will ramp up, investment in. Inflation has been a stubborn issue, continues to stick around. And if you've got declining consumer demand overall, even if Amazon's doing particularly well, they've still got some fixed costs to take care of and salaries they've just hiked. How are investors, you think, going to overlook that to get you to that price target if that continues to unfold in 23?
Yeah, well, clearly a lot has to go right overall. And we heard last week they're actually raising their, I think, minimum wage or average wages that they would add about $1 billion in costs or so. That was per press release. And so all that is taken into account in how we think about it. But I think the number one thing that we get back to when it comes to efficiencies is you have to remember back in 1Q, they were talking about, or in 4Q actually, they're talking about $6 billion of incremental costs for this first quarter in 1Q of 22. As they exit here in 3Q, that $6 billion is whittled down to about two and a half. And of the six, $2 billion of that was due to headcount and inflation. Or headcount, $2 billion was due to fulfillment centers, and we know this, and the other two count around inflation. There's a lot of concern that they could even get that down to a manageable amount, particularly on the warehouse side, and yeah, frankly, we think they're doing that.
Yeah, I thought they might be able to. They're pretty efficient over there. Ron, thank you. Ron,
yeah.
Josey.
Thank you, John.